Swayam Prabha. Digital India. Educated India.
योगः कर्मसु कौशलम्.
Dear viewers, I am C.S. Yashra Dikshit, and in today's session I am going to discuss concept of corporate governance, definition of corporate governance, what is corporate governance, need for corporate governance, scope of corporate governance, the company and its stakeholders, ownership and control. So viewers, by the end of this session you would be able to understand number first, concept of corporate governance, number second, definition of corporate governance, number third, what is corporate governance, number four, salient advantages of corporate governance, number five, need for corporate governance, number six, scope of corporate governance, number seven, the company and its stakeholders, number eight, ownership and control. So let us begin our today's session with understanding the concept of corporate governance. The concept of governance is a very old phenomenon in India, dates back to the 3rd century. Corporate or a corporation is derived from the Latin term corpus, which means a body. Governance means administrating the processes and systems placed for satisfying stakeholder expectation. The root of the word governance is from gubernate, which means to steer. The word governance can be used in several contexts such as corporate governance, national governance and international governance. Corporate governance means a set of systems, procedures, policies, practices, standards put in place by a corporate to ensure that relationship with various stakeholders is maintained in transparent and honest manner. The phrase corporate governance describes the framework of rules, relationship, systems and processes within and by which authority is exercised and controlled within corporation. It encompasses the mechanism by which companies and those in control are held to account. Corporate governance encourages a trustworthy, moral as well as ethical environment. In other words, the heart of corporate governance is transparency, disclosure, accountability and integrity. Good corporate governance is essential to develop added value to the stakeholders as it ensures transparency, which ensures strong and balanced economic development. Now that we will discuss the definition of corporate governance. According to James D. Wolfens, 9th President World Bank described that corporate governance is about promoting corporate fairness, transparency and accountability. According to International Chamber of Commerce defined that corporate governance is the relationship between corporate managers, directors and the providers of equity, people and institutions who save and invest their capital to earn a return. It ensures that the board of directors is accountable for the pursuit of corporate objectives and that the corporation itself conforms to the law and regulations. According to Mervyn King, Chairman, King Report described that good corporate governance is about intellectual honesty and not just sticking to rules and regulation. Capital flowed towards companies that prescribe this type of good governance. Now we will discuss what is corporate governance. Corporate governance is a system of structures and processes to direct and control companies. It specifies the distribution of rights and responsibilities among companies' stakeholders, including shareholders, directors, and managers, and effective the rule and procedures for making decisions on corporate affairs. Thus, corporate governance provides the structure for defining, implementing, and monitoring a company's goal and objectives and ensuring accountability to appropriate stakeholders. The director's role in improving the effectiveness of a company's governance can be described as an agent of change. Good corporate governance promotes investor confidence, which is crucial to the ability of entities listed to compete for capital. Good corporate governance is essential to develop added value to the stakeholders as it ensures transparency, which ensures strong and balanced economic development. This also ensures that the interests of all shareholders, majority as well as minority shareholders are safeguarded. It ensures that all shareholders fully exercise their rights and that the organization fully recognize their rights in the company. Corporate governance helps to develop systems and processes of a company and providing set of policies which include minimum right of shareholders, clarifying the board's leadership role and providing adequate transparency and disclosure. Now, in this section, we would discuss various salient advantages of corporate governance. Number first, good corporate governance ensures corporate success and economic growth. Number second, strong corporate governance maintains investors' confidence as a result of which the company can raise capital efficiently and effectively. Number third, there is positive impact on the share price of a company. Number 4, it provides a proper inducement to the owners as well as managers to achieve objectives that are in the interest of the shareholders and the organization. Point number 5, good corporate governance also minimizes wastage, corruption, risk and mismanagement. Number 6, it helps in brand formation and development. Number 7, it ensures organization is managed in a manner that fits the best interest of all. Now, we will discuss the need of corporate governance. Corporate governance is integral to the existence of the company. Corporate governance is needed to create a corporate culture of transparency, accountability and disclosure. Number first, corporate governance. Improved governance structures and processes ensure quality decision making, encourage effective succession planning for senior management and enhance the long-term prosperity of companies, independent of the type of company and its sources of finance. Number second, enhance investor trust. As individuals and institutions invest capital directly or through intermediary funds, they look to see if well-governed corporate boards are there to protect their interest. Investors who are provided with high levels of disclosure and transparency, such as relating to data on matters such as pay governance, pay components, performance goals, and the rationale for pay decision, etc. Number third, better access to global market. Good corporate governance system attract investment from global investors, which subsequently leads to greater efficiency in the financial sector. The relation between corporate governance practices and the increasing international character of investment is very important. International flow of capital enable companies to access financing from a much larger pool of investors. Number 4, combating corruption. Companies that are transparent and have sound systems that provide full disclosure of accounting and auditing procedures allow transparency in all business transactions, provide environment where corruption would certainly fade out. Corporate governance enables a corporation to compete more efficiently and prevent fraud and malpractices within the organization. Number 5. Easy finance from institutions. Several structure changes like increased role of financial intermediaries and institutional investors, size of enterprise, investment choices available to investors, increased competition and increased risk exposure have made monitoring the use of capital more complex, thereby increasing the need of good corporate governance. Number 6. Enhancing enterprise valuation. Improved management accountability and operational transparency fulfill investors' expectation and confidence on management and corporation, and in return increase the value of corporation. Point number 7. Reduce risk of corporate crisis and scandals. Effective corporate governance ensure efficient risk mitigation system in place. A transparent and accountable system makes the board of a company aware of the majority of the mask risk involved in a particular strategy, thereby placing various control systems in a place to facilitate the monitoring of the related issues. Number 8. Accountability. Investor relations are essential part of good corporate governance. Investors directly or indirectly entrust management of the company to create enhance value for their investment. The company is hence obliged to make timely disclosure on a regular basis to all its stakeholders in order to maintain good investor relation. Now we will discuss scope of corporate governance. Number first point, role and powers of board. The board is the primary direct stakeholder influencing corporate governance. Directors are elected by shareholders or appointed by other board members and are tasked with making important decisions such as corporate officer appointments, executive compensation and dividend policy. The board as a main functionary is primarily responsible to ensure value creation for its stakeholders. The absence of clearly designated role and powers of board weakness accountability mechanism and threaten the achievement of organizational goals. The important requirement of good governance is a clear identification of powers, roles, responsibilities and accountabilities of the board, CEO and the chairman of the board. The role of the board should be clearly specified in a board charter. Point number 2, legislation. The clear and unambiguous legislation and regulations are fundamental to effective corporate governance. Legislation that requires continuing legal interpretation or is difficult to interpret on a day-to-day basis can be subject to deliberate manipulation or inadvertent misinterpretation. Number 3, board skill. To be able to undertake its functions efficiently as well as effectively, the board must possess the necessary blend of qualities, skills, knowledge and experience. Each of the directors should make quality contribution. A board should have a various skill such as operational or technical expertise, commitment to establish leadership, financial skills, legal skills, knowledge of government and regulatory requirement. Point number 4, board induction and training. Directors must have a broad understanding of the area of operation of the company's business, corporate strategy and challenges being faced by the board. Attendance at continuing education and professional development programs is necessary to ensure that directors remain abreast of all developments which are or may impact on their corporate governance and other related duties. Point number 5, board independence. Independent board is essential for a sound corporate governance. This goal may be achieved by associating sufficient number of independent directors with the board. Independence of directors would ensure that there are no actual or perceived conflicts of interest. The board needs to be capable of assessing the performance of managers with an objective perspective. Accordingly, the majority of board members should be independent of both the management team and any commercial dealings with the company. Point number 6, board meetings. Directors must devote sufficient time and give due attention to meet their obligations. Attending board meetings regularly and preparing thoroughly before entering the boardroom increases the quality of interaction at board meetings. The effectiveness of board meetings is dependent on carefully planned agendas and providing relevant papers and material to directors sufficiently prior to board meetings. Point number 7, code of conduct. It is essential that the organization prescribe norms of ethical practices and code of conduct are communicated to all stakeholders and are clearly understood and followed by each member of the organization. System should be in place to periodically measure, evaluate, and if possible recognize the adherence to code of conduct. Point number 8, strategy setting. The objectives of the company must be clearly documented in a long-term corporate strategy, including an annual business plan together with achievable and measurable performance targets and milestones. Point number 9, monitoring the board performance. The board must monitor and evaluate its combined performance and also that of individual directors at periodic intervals using key performance indicators besides peer review. The board should establish an appropriate mechanism for reporting the results of board's performance evaluation results. Point number 10, audit committees. The audit committee is responsible for communication with the management, internal and statutory auditors, reviewing the adequacy of internal control and compliance with significant policies and procedures, reporting to the board on the key issues. The quality of audit committee significantly contributes to the governance of the company. Point number 11, risk management. Risk is an important element of corporate functioning and governance. There should be clearly established process of identifying, analyzing and treating risk which could prevent the company from effectively achieving its objectives. Appropriate control procedures in the form of risk management plan must be put in place to manage risk throughout the organization. Now, we will discuss the company and its stakeholders. A large number of key players in the market played an important role in the organization. A shareholder is any person who owns shares in a company. Stakeholders are any identifiable group of individuals or organization who have an impact upon or be impacted by the company. Stakeholders groups typically include directors, shareholders, senior executive management, other employees, customers, suppliers, the general public, regulators and the government. The shareholders are the true owners of the company, but since shareholders are a body of individuals who are distracted over and not communicating with each other, real control lies with the promoter group holding substantial or majority stake and with certain organized shareholders like financial institution. Now we will discuss ownership and control. Corporate governance issues arises from the roles of agency and stewardship. Agency involve the transfer of capital from the shareholders to the control of managers. Stewardship refer to the director's role as a guardian of a company assets. The shareholders through the board delegate authority to manage and entrust the board to act on their behalf. This role are important when a company's owners are different from its managers. This separation of the ownership and control functions within a company inevitably leads to the managers being made responsible for the spending of other people's money. For an effective relationship to be maintained between the providers of money and company managers, high level of trust must exist between both. So friends, let us summarize the session. We discuss number first, corporate or a corporation is derived from the Latin term corpus, which means a body. Next, governance means administrating the processes and systems placed for satisfying stakeholder expectation. Next, corporate governance is a system of structures and processes to direct and control companies. Next, good corporate governance ensure corporate success and economic growth. Next, the shareholders are the true owners of the company. I hope this session would have made your concept for the concept of corporate governance, definition of corporate governance, what is corporate governance, need for corporate governance, scope of corporate governance, the company and its stakeholders, ownership and control very clear. I hope you have enjoyed this session. Thank you.